Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews. I'm joined by Rob Everett, who's the CEO of the Financial Markets Authority. Welcome in, Rob. Thanks for joining us. Look, you've been in the job now 6 or 7 months. Obviously, the FMA was set up back in 2011 after the finance company collapses to restore the ma and pa retail investors' confidence in the capital markets. I'd be interested in what you've found, I guess, having come in from overseas, what you've found in New Zealand, where you think that investor confidence is at the moment.
Sure. So I always say to people, one of the advantages that New Zealand has is it did completely rewrite its financial services legislation, so a really major overhaul, and done in a non-partisan way. So actually the newly constructed financial services regime makes a lot of sense. I think it was thought about very carefully and wasn't distorted by some of the political posturing you've seen in other major jurisdictions. So I think that was very positive, and that was good to find when I arrived. In terms of breeding confidence in investors that they can participate in the markets, it can be hard to distinguish that from a benign economic environment where the markets are up, KiwiSaver's up, stock exchanges up. Our surveys tell us that people are more confident than they were. Again, distinguishing between general market confidence and confidence in the regulator is tough. But we think we've made big strides in enforcing against some of the misconduct that happened, pre the FMA, and also some of the work we're doing with investors to try and make them more confident about the decisions they have to make. So far so good, I think.
Now, obviously, in your job, you're dealing with the big companies, the lawyers, accountants, but also the ma and pa retail investors who in many cases will have fairly rudimentary understanding of investing and the financial markets. You've come from a background, obviously you had a long stint at Merrill Lynch, among other things, so you're probably used to dealing with the masters of the universe. How are you finding getting the message across to the retail investors?
Well, it's a critical part of the mandate. You're absolutely right. We have to deal with the biggest end of town, but we also have to deal with the users of financial services, people who invest in the markets. And so it is a challenge to get to that population, particularly given some of what's happened in the past. But it's a real focus for us. So, for instance, we're doing stuff in Money Week in a few weeks' time, where we have a panel on trying to help people understand investment risk. We produce a lot of materials for users of financial services, which are on our website and in other places. And we do focus a lot on the ultimate outcomes for the users of financial services. So, for instance, the work we've done with the big end of town on offer documents and disclosure has been very much to remind them that actually ordinary people have to read those documents. And if ordinary people decide they're not going to read a 300-page complex document, then it's failed. And so a lot of the work we're doing leaning on the big end of town is designed to help ordinary investors actually understand what they're investing in.
Now, obviously, you came in after the FMA had been formed after the finance company collapsed, so that was in the past, but you've still had a few cases running, most of which have now been concluded. But probably the big one that's remaining is the Hanover one, where obviously you will have ascertained there's a lot of public interest in that one. The FMA filed civil proceedings against directors and promoters of Hanover back in 2012. Can you give us a bit of an update in terms of where things are at? I mean, do you have a court date set yet? Are there settlement talks going on? The
wheels of justice move very slowly, and that's not unique to New Zealand in any way. So the next court date is not till next year, middle of next year. Obviously, we may end up in settlement discussions. I can't really comment at this point. But we are nearing the end of a slew of cases that relate to activity before the FMA, and in fact, many of them proceedings started by the Securities Commission. So we feel we're now getting to a point where we're more likely to be enforcing on things that are happening today rather than happening in the past, and that's a really good place for us to be moving to, I think.
And just in terms of Hanover, there's no trial date set at this point?
No, next court hearing date, I think middle of next year, but no trial date, so it's a way off.
Now, you've come from Britain, and obviously coming from Britain, where retail property is very popular, a very popular form of investment like New Zealand, I'd be interested in your views on the New Zealand obsession with retail property as an investment class, and what sort of risks you may or may not perceive in that.
So I have to be careful, obviously, telling people not to go too deep into New Zealand property, given I think if you were in Auckland in particular, over the last 5 or 10 years, actually, that would have performed pretty well for you. So the focus for us is really less on the specific asset class and more to point to the risk that a lot of people will be putting all their eggs in one basket. So there's not a lot of diversification if you put all of your spare money into property, particularly on an investment basis. And part of what we're trying to do is to encourage people to look more broadly at where they can invest their money and to really think hard about the risk profile of doing that. And in some cases that might encourage people to invest away from property. In some cases it won't. But the key for us is really to help build more choice in investment products and to encourage people to understand what the different profiles of those investment decisions should look like.
Now, you've already mentioned the share market's been performing very strongly. We've seen a whole lot of IPOs this year. Who should invest in the share market and why?
It's a similar answer, actually, which is that the share market, and in particular IPOs, ought to be just one component of someone looking at a range of investment choices. And so again, we wouldn't encourage ordinary investors to put all of their money into the share market, and particularly not all of their money into IPOs. So again, it's really a question of a healthy share market with lots of choice in terms of the sectors represented and the size of the companies being a really good thing for people looking to make investment choices. That's a long way from saying to people that they should put all of their money in. So again, just like with property, it really needs to be for people who understand what their risk appetite is and their time horizons for when they might want to get money out, and to look at some of the greater choice that's now appearing on the NZX.
Now we've got a situation where NZX, the operating company of the share market, also has some regulatory responsibilities. Is that the right arrangement? I mean, is there no conflict of interest in them doing that?
It's a fair question. So it's not a unique model to have the stock exchange operator operating as a frontline regulator for a lot of the market rules and the market participants, and so that's a model you see elsewhere. You're absolutely right, though. The advantages of being closer to the market and the market participants and the market activity, which in theory gives the exchange actually a better understanding of what's happening in its markets, is balanced by the risk that the exchange is focused on its commercial objectives and may not resource its enforcement and monitoring functions as one would like. And if you look at the way the FMA has been monitoring the NZX, both on a regular basis and as part of its annual review, those are the topics that we focus on for that exact reason. If you look at what's happened elsewhere in the world, those issues around the conflicts between its business objectives and its regulatory objectives and the resourcing of its enforcement activities tend to be the ones that the primary regulator, in this case us, needs to zero in on to make sure that they're happening okay.
And at this point, is there any sort of desire from the FMA that NZX sort of ends being a regulator as well as an operator? No,
we haven't made those proposals, and at the moment we think the NZX is actually developing well in the direction of putting good resources into monitoring trading. They've got a brand new system from Wynyard, which they spent a lot of money on, a new governance structure, new conflicts focus. So actually at the moment we're quite happy with the direction NZX is moving in.
Now, KiwiSaver is obviously a big area of focus for the FMA. How big of a focus is it?
Well, it's huge for us. I mean, KiwiSaver obviously is getting bigger and bigger and bigger, $20 billion or more already in it. And for many people, for many ordinary people, it's their first experience of investing. It may be, in fact, their only experience of investing, and in fact, some of those people may not really see it as an investment. So actually for us, KiwiSaver is massive, which is why we've just put out a monitoring report on some of the things going on in KiwiSaver. It's why we spend a lot of time with the trustees who basically supervise the KiwiSaver schemes. And for us, when we look at the overall environment that we regulate, KiwiSaver just gets bigger and bigger and bigger. So it's incumbent on us to spend a lot of time making sure that the infrastructure and the governance of that is sound.
Now, you mentioned the monitoring reports that came out recently. There were a few reasonably unflattering things said about banks in there. Banks are very dominant in KiwiSaver now. They're managing the bulk of the money. Are they abusing their sort of scale here?
Well, you can't blame the banks for wanting to grow bigger mass in KiwiSaver. So I don't have an issue with that particularly. But obviously it does pose the risk that you've got an unbalanced kind of marketplace in terms of the competitive environment. And we have seen in our monitoring, and we have seen in some of the complaints that we've had, the beginnings of some behaviour, particularly around encouraging people to switch, that suggests to us that some of the bigger providers need to spend more time on training their people and making sure that they're not encouraging people to switch who actually don't have a reason to switch, or indeed having someone switch who hasn't really realised that's happening. So we are seeing some issues there, but we're not seeing anything systemic at the moment. But our view is we need to jump on it as quickly as we can, because with that ever-growing component of the market, we can't really afford to end up into some sort of switching scandal.
So, I mean, what can you, as the FMA, do to make sure, I guess, the banks behave themselves and put the customer first and aren't overly focused on cross-selling and switching?
So it's a combination of things. We're very focused generally at the FMA on the tone that's set at the top of organisations. So we have conversations with the boards and executive management of these organisations to make sure they understand they own the outcomes that are happening kind of in the bank branches and at the tills, if you like. And secondly, the monitoring we do enables us to pick up instances where we think the practices aren't working as well as they should, or the training's not working as well as it should, or indeed in some cases the sales incentives are causing poor behaviour or mistakes to be made. So it's a combination of talking at the very senior end of the banks and the providers, but also having a monitoring framework and a complaints framework, a source where we can get information from people who feel bruised by their interactions, to make sure we put those two together and we're as open and transparent as we can in terms of the feedback we're giving to the banks. Hence the monitoring report, which, as you say, would have been a bit bruising in a couple of places. That's to try and make sure everyone's on the same page as to what we're seeing and what needs to be fixed.
But there's no actual action being contemplated by the FMA at this point against the banks to make them...
We have a number of situations which we're looking at to work out what the right regulatory response would be. The primary or the first response would always be to try and be open about what we're seeing, so that banks and other providers have got a chance to look for themselves at what they're doing to make sure it's fit for purpose. But obviously if we see organisations that are kind of repeat offending or not setting up the governance that would enable them to monitor this for themselves, then we'll be looking at taking action.
Now, your predecessor, Sean Hughes, obviously he came from a background at ASIC in Australia, and he talked about the potential for prudential regulation of KiwiSaver along the lines of the Australian superannuation schemes. Have you looked at that as something that might be required in New Zealand, or are there any sort of particular other pieces of the regulatory puzzle that KiwiSaver might need in your view?
Well, I guess to the first point, the balancing aspect there really is that the funds that go into KiwiSaver, people's money that goes into KiwiSaver, is held in trust and it's segregated from the provider. So even if the provider was getting into difficulty, and obviously they're all prudentially regulated by the Reserve Bank, that money is separate from the overall funds of the provider, and I think that's really critical. And one of the reasons we focus on the trustees, and we've been trying to drive standards up in the trustee sector, is that they have a critical role to make sure the providers are investing that money the way they're supposed to. So actually we don't really at this point see a need for prudential regulation, because it wouldn't really add anything to protection for investors. Obviously the more that goes into the bigger providers, the more of an issue there will be for everyone across the piece if one of those providers fails. But there are mechanisms for transferring KiwiSaver schemes should that happen. So your other question, the other focus for us on KiwiSaver is really at the end of KiwiSaver. So when people come out of KiwiSaver with lump sums, and obviously we're not the only agency looking at this, the Commission for Financial Literacy and Retirement Income looking at this too, is trying to make sure that people are equipped with the advice they need, the information they need, when they come out of KiwiSaver with lump sums, to invest that money so that it actually carries them through retirement, rather than going and spending it on a boat or a new bathroom, which is some of the early examples we saw, albeit from people who hadn't been in KiwiSaver very long, so it probably felt more like a windfall.
Now, you made a recent speech to the Institute of Directors, I think it was, and you talked about conflicts of interest among directors in New Zealand, and you said this was actually more of a conflict of duty, which was an interesting point, I thought. How big of a problem do you see this in New Zealand? Obviously, it is a relatively small country, a very small country compared to some others. Yeah. And what would you like to see done about this?
So I think two particular issues for New Zealand, which is why I picked out conflicts of interest and conflicts of duties. It is a small business circle, and so almost inevitably you do end up with a lot of the more senior and experienced players with a number of roles, and that's, I think, a natural component of the New Zealand financial market. But I think that makes it all the more critical that investors can trust that people are properly separating out their different duties to different parties and their own personal interests. And I think I felt when I arrived, I saw some signs of complacency and tolerance of situations where even if there was not, in fact, someone acting in a conflict of interest, the appearance was there. And this is a space where the appearance of people acting in conflict is just as damaging as the actual reality if it does turn out to be the case. And so really I was just trying to put that at the top of a lot of people's agendas, which is not to say that you can completely eradicate situations where people have duties to different companies or different participants, but that you need to be really clear in how you deal with that and how you separate it. So, for instance, we pushed the NZX very hard on their own in sort of internal conflicts of interest and conflicts of duty, and we at the FMA spend a lot of time making sure that our board and our management similarly are segregated in terms of issues where there might be a conflict of interest. So I think for the market as a whole, if you want to encourage confidence in ordinary investors that the market is not rigged against them, to use some of the US terminology, I think conflicts of interest for New Zealand is a topic well worth focusing on.
Now, I just thought I'd finish off by asking you, are there any particular regulatory issues that keep you awake at night at the moment?
Yeah, plenty. The main one I've just mentioned, actually, which is complacency. Right, we're in a relatively benign and stable economic environment, and I think it's incumbent on the regulator occasionally to remind people of some of the issues that have gone wrong in the past, some of the issues that have gone wrong in other jurisdictions. So whether that's the providers of financial services, whether it's the users, the investors, and reminding people that what goes up doesn't always stay up, reminding the providers that just because it hasn't happened in New Zealand doesn't mean it doesn't exist here, and also reminding us, the regulators, that actually just because we're not finding things that have gone wrong doesn't mean that we need to stop looking. So that's the thing that worries me most, is people beginning to take their foot off the pedal of financial services reform and taking the view that everything's all right just because the prices are up.
Okay, well, look, thanks a lot for that, Rob.
Pleasure.
That's Rob Everett, the CEO of the Financial Markets Authority, and I'm Gareth Vaughan at interest.co.nz.